I'm Anthony Valeri, Director of Investment Management at Zions Wealth. Thank you for joining our 2025 Economic and Financial Market Outlook series. This is the second quarter webinar, and first, apologies for the Zoom outage, which is causing this recording, but we hope nonetheless you'll find these comments insightful and informative as an investor. So let's go ahead and begin. Well, it's all about tariffs in the economy and financial markets. It's been certainly the focus throughout 2025, but especially since the beginning of April with the announcement of reciprocal tariffs. There's been some back and forth. This chart shows the tariff history in the United States, and you can see the sharp increase on the far right. Still some estimates to fine tune exactly what that percentage is. But it is north of 20%. That is going to be roughly 2% of GDP. This is a significant tax hike, or the equivalent of a tax hike, and hence the market volatility and uncertainty in the market. So that is the focus. What does that mean? What is the tariff impact? Well, even with the recent repeal of reciprocal tariffs, broad tariff rate is still above 20%. Ultimately needs to be seen what the effective tariff rate is, but it's still looking to be north of 20%. The impact is that economic growth will slow and inflation, at least over the near term, is expected to increase. The market, however, putting a much greater emphasis on the negative impact to growth. We'll talk more about that. On a positive note, corporate profit margins are wide, but they will be negatively impacted by the tariffs. We saw a couple of semiconductor companies announce some negative impacts today, April 16th, as a real live data point to that. Even the recent electronics exemption and the possibility of forthcoming tariffs on semiconductors and pharmaceuticals keep uncertainty high. And because of that, we think volatility will linger. This isn't a quick exit for investors. Unfortunately, we're going to see a volatile market continue over the near term, and perhaps longer in 2025. So how much will economic growth slow and inflation increase? This is the expectation from Bloomberg. This is Bloomberg consensus forecasts as of early April. You can see that CPI forecasts have begun to ratchet higher and GDP estimates lower. It's very likely that GDP, in our view, will fall below that 1.8% consensus where it is now. I think very slow growth is the likely outcome, thinking between 0 and 1% roughly. But we'll have to see on that. Not a recession in our view, but when we look at the CPI index, the news, at least the last CPI report, was relatively favorable, but that's old news as we await the potential impact of what tariffs may do to inflation. So that's the immediate impact. On the positive side, corporate margins have been wide relative to history. That does give U.S. corporations the ability to absorb a lot of those cost increases, and it really remains to be seen how much of those tariff increases are offset by currency declines, as China's currency has devalued since the announcement of tariffs. How much do corporations substitute goods, and how much is ultimately passed on to consumers? So lots of questions. The good news, again, corporate profit margins fairly wide. And on the consumer front, consumers have done financially very well over recent years. They've refinanced a lot of their higher interest obligations. They are on sound financial footing, thanks in large part to the strength in the markets and also job gains, wage and salary increases over recent years. This is data from the Federal Reserve on U.S. household net worth. You can see the increase post-COVID, and that acceleration has been maintained in recent years. So consumers financially in very good shape and able to withstand the impact of tariffs. In terms of the economy, it ended the fourth quarter on a very positive note, and that momentum carried into the first quarter, although slowing. Jobs market through the first 3 months of 2025 still showing some steady job gains. 228,000 was the increase in non-farm payrolls for the month of March. You can see the 6-month average has actually increased in recent months. This is a bit old news. We'll see how this impacts or what the impacts are going forward. But the labor market has held in relatively well despite some recent signs of slowing. But again, you're not seeing the job losses that would indicate a recession. That's something to keep an eye on as we move forward. One of the indicators where we'll see it first is weekly jobless claims, and no stress there. The gray bars represent recession. Weekly claims still very low on a historical basis. We might see some impacts from Doge layoffs, but as of now, not seeing any impact in this key and leading indicator of the U.S. economy. The consumer has certainly slowed spending, but far from weak. So outside of household net worth, if we look at the pace of consumer spending, we do so through retail sales, two measures: total retail sales on an annualized percent change, and then we can focus on core retail sales, which exclude autos and gas. And yes, there has been a slowdown in the first quarter relative to the fourth quarter, but these on a high level, this consumer spending is far from weak. So the consumer, again, entering this period from a position of strength. We are, however, seeing some signs of weakness. Two top-tier indicators, the ISM services report and the ISM manufacturing, have both slowed for the month of March. The light blue line or lighter blue line is the manufacturing survey, which decelerated below 50. That's a demarcation for expansion and contraction. A reading below 50 indicates contraction, above expansion, and manufacturing back to that sluggish pace we've seen for much of the past 24 months. Services, a bit of a concern after the slowdown in March, suggesting that the economic slowdown in the first quarter is very real and something to watch with tariffs. Timing adding to the volatility in the market and concerns of the economy going forward. So still early, and remember, services are 85% of the economy. We'll have to watch some slowing, but that is why we continue to have volatility. It will take time to see what those ultimate impacts are to the economy. Aside from the actual data, the media has really focused on sentiment in the market. Sentiment is a contrarian indicator. And although many of the sentiment reports, CEO confidence, consumer confidence, University of Michigan consumer sentiment, all have been very, very negative in response to tariffs. These are feeling type indicators, and they don't translate or are different from the actual hard data. One positive on this data, and it can be a negative. Before I get to the positive, the reason it can be a negative, it can force businesses and consumers to postpone key spending decisions. That hasn't happened yet. Something to watch, but do keep in mind when sentiment gets very, very negative, it has historically been a good contrarian indicator. So when we look at University of Michigan consumer sentiment, it is in the lowest 10% of observations. Historically, when that's happened, the forward returns for the stock market have been very strong, averaging 16.2% for the coming 12 months. So do bear in mind that negatives in consumer sentiment are a contrarian indicator for investors. Let's turn to performance for the first quarter and then through April 11th, last Friday. Dark blue lines show the first quarter. The medium blue show performance as of April 11th, and obviously the much more negative reaction in early April. But it does show a consistent trend here, meaning those areas that lagged generally in the first quarter continue to lag even in April. Biggest laggard is small cap US on the far right. Third from the right is US large cap, the S&P 500, which had dominated performance the past 2 years, underperforming but relative to several other asset classes, including the US large cap equal weight, which is down 6.9%. But if you move to the left, look at it, developed international and high quality bonds. Being diversified helped. From the equity side, it was developed international and emerging market equities, which held up better. And high quality bonds provided an offset over the first quarter. Some weakness in bonds to start April due to disruption from the tariff announcements. We'll talk more about that in a moment. But being diversified helped, and it's been a leadership change within the financial markets. Perhaps the most notable standout, international stocks outperforming by the most since 2002. You'll see that here. It eclipsed the outperformance of 2022. So you have to go all the way back to 2022 to see a quarterly outperformance of developed international relative to U.S. stocks. So a strong showing. You can see also that U.S. has had the better of it since 2010, but in the early 2000s, international stocks frequently outperformed. And if the U.S. dollar continues to weaken from its near historic high using the real trade weighted dollar from the Fed, we might see an additional tailwind for international. And a lot of that due to the much cheaper valuations of international equities relative to the US, and those growth differentials are narrowing. It remains to be seen whether this performance can be sustained. We're going to have to see better economic growth overseas and also better corporate profits for those international equities. In terms of sector performance, a real change in tune here. No surprise that through April 11th, the more defensive sectors within the equity markets have outperformed: consumer staples, utilities, healthcare. These also contain some of your higher dividend paying names. And then note the big reversal from 2023 and 2024. Technology, consumer discretionary, lagging the broad market. This is a big change, and this is something that is notable, and it hasn't changed since the end of the first quarter. So despite the volatility and declines in the first quarter, those two sectors have still lagged going into April, perhaps less so, but it's interesting to note this change in the market, and there is still a defensive tone within the equity markets. We believe that you should be diversified with those dividend payers, a blend of both growth and value in your investment portfolios. Now, what are some of the positives? Well, there's been a significant decrease in equity valuations. This was through April 4th, and it shows the forward price to earnings ratio of the Magnificent Seven, which have borne the brunt of the selling in the equity market. The medium blue is the S&P 500 market cap, which briefly went below its long-term average in terms of valuation, but has since rebounded a little above that. The S&P 500 equal weight also below its long-term average, but now roughly in line with its longer-term average. Here, there are much better values within the equity market. Again, another reason to be diverse and not chase those big names that led performance over the past few years. It does seem like a change in leadership in the market, so be leery of the former leaders in the market. So valuations have certainly cheapened, and this also suggests that the markets have sustained a fair amount of damage. When you have a PE ratio go down by 4, 5, 6 points, that is a significant change by any historical context. So it does show that there are much better valuations in the equity market, something to think about as you stay committed to a longer term plan or look at increasing dollars over time. What are we watching from an equity perspective? Downward reversions to earnings are coming, and the earnings story has been a key driver of stock prices over the last couple of years, especially in 2024, where the dark blue bars show that earnings often exceeded the consensus forecast in the lighter blue and often beat those numbers by a significant margin. Earnings growth for all of 2024 was 10%, and it was the strongest since 2021. So corporate America came into 2025 on very strong footing. We still expect earnings to be the long-term driver of stocks, and that's why we have uncertainty here in the markets. That expectation on the far right for 10% earnings growth is coming down. Using Bloomberg estimates, the growth rate is now expected to come in less than 9%. Expect this to be revised even further lower. Refinitiv data shows a growth rate in the mid 9% range. Those are still very healthy growth rates, but we do expect some additional slowing in terms of earnings growth, and that's likely to linger over the equity markets here over coming weeks and months. And as we look at how do we find fair value in the S&P 500, just a quick scenario analysis. If earnings end up slowing more than anticipated, let's say 5%, which is where some of the estimates are now, or have some of the more negative estimates in terms of earnings growth rate have fallen to 5%. And if we apply a PE ratio of 18, that implies fair value of about 4,600 on the S&P 500. However, this scenario analysis doesn't include positive earnings growth in 2026 or 2027. More of a downside scenario if that 18 PE ratio comes to be realized. However, if you look at a PE ratio of 20, that becomes a fair value of 5,145, which is about 100 points below where the S&P stands today, April 16th. So the market's getting close to a fair value. The risk is, however, if earnings decelerate further, if there is 0% growth or a decline, as is often the case in a recession, then the fair value for the S&P 500 could be lower. Again, we don't expect a recession. Think of it more as a slow growth environment. But just to walk you through some of the scenario analysis within the equity market, interesting, 4,800 ended up being a support for the market, partly due to a change in tone from the administration. Treasury Secretary Scott Bessent taking the lead on tariff negotiations. He seems more in tune with the market disruption equities and the disruption in the bond market. So viewed by investors as an off-ramp and a potential change going forward. Let's look at bonds and the 10 and 2-year Treasury yields. Those yields have increased to start April after declining for much of the first quarter. There's been some disruption in the bond market. Several factors driving that led to the slight spike in yields you saw at the beginning of April. A reversal of leverage trades from hedge funds being one of that, and also institutional selling of leverage trades. Foreigners potentially selling US dollar assets, including treasuries. We're not seeing a lot of hard data confirming that, but it is potentially a driver. And on a positive note, we did see strong investor demand of treasuries last week at new 10 and 30-year auctions. And I would say poor liquidity in the bond market has also exacerbated this weakness. But since that jump above 4.5, the 10-year Treasury yield back down to 4.2. 4.5, not too disturbing. And from a broader context, really, if there was true stress, you'd see that 10-year shooting up above 5. We see more of a range-bound environment for bonds, continuing what we've seen over the past 2 years, really. Those yields unlikely to go much higher unless we do get a spike in inflation that is greater than anticipated. Conversely, if there is a recession, could very well see Treasury yields come down much further and perhaps challenge that 3.5% low on the 10-year. But we do expect a range-bound environment, coupon clipping, as we say in the bond market, collecting interest with little in terms of price fluctuation. In the muni market, the liquidity has translated into definitely a disruption and weakness in prices. 10 and 30-year AAA muni yields shooting up here in April, and for part of the first quarter as well. The beginning of March through mid-April is a seasonally difficult period for municipals, and the market volatility certainly exacerbated that move. On the right, we show municipal valuations, municipal yields as a percent of treasuries, and the dark blue line, which is the 30-year average AAA rate, is above 100%, meaning you're getting the tax benefit for free. The 10-year also getting more attractive relative to its recent history. Historically, when you see these jumps, they've been good buying opportunities for municipal investors. We don't see this as a credit concern for the muni market, more a function of poor supply-demand imbalances. And in terms of the Fed, investors are hoping the Fed will step in. Today, Jerome Powell was non-committal, as he was about 2 weeks ago, saying it's too early to decide on cutting rates if the economy will slow. It's too early to assess the impact of tariffs. Markets, in both cases, didn't like that response. Nonetheless, the markets believe the Fed will have to act if tariffs stay where they are now. Nearly 4 rate cuts are priced in for 2025. The Fed continues to project 2 rate cuts. We'll see if they get forced to do more, but that's where we stand in the market versus the Fed's forecast. And again, Fed officials holding firm for now. The market is projecting the overnight rate to drop into the low 3% range, or mid 3% range by end of 2025, with additional cuts in 2026. So this is the longer term view here. The medium blue shows where the rate expectations were at the end of February, and of course on April 10th, a notable adjustment following the tariff announcement. So markets expecting more rate cuts, and do keep in mind, if the bond market truly did become unhinged, if there was a lack of participation where yields were moving quite a bit, we would expect the Fed to step in and support the market. In terms of fixed income investing, we are focused on high quality bonds. You're simply not getting compensated properly for lower rated debt. This is the average high yield spread relative to Treasury, the average yield advantage to comparable maturity Treasuries. You can see that yield spread has increased, but it is still below the historic average of around 5%. And again, so notable jump, but not something that would scream value or cheap by a historical context. So we are focused on higher quality bonds. Now, is the equity market sell-off over? Well, there's a few metrics we follow, one of which is the VIX, which spiked to one of its highest readings last week on record, almost over 50. Rare to see that kind of measure. That's usually one of the signs of exhaustion in a sell-off. Also, the percentage of S&P 500 stocks above the 200-day moving average, when that falls below 20, that often marks a point of selling exhaustion. We hit that briefly in early April, that condition is no longer apparent. It doesn't necessarily or immediately suggest the end of the sell-off, but it suggests we're a lot closer. The market could do a retest. In fact, in most cases, when you have a sharp sell-off, the equity market does retest its prior low. So some signs that we're getting closer to the end. But again, we think this is going to linger for some time, as we often, 85% of the time, actually, you get a retest of the low. That didn't happen in COVID, but something that historically has been the case and worth watching. A reminder that volatility is normal. Investors have gotten used to limited volatility in the equity markets last year and even the prior year. And here so far in 2025, peak to trough, the S&P was down 19%, almost a bear market. And a bear market is rare outside of a recession. If there is a recession, bear markets are often more severe, with the average decline of about 27%. As of year-to-date number, down 10% for the S&P 500. So some significant selling has already occurred. That green line reminds you that the average intra-year decline, peak to trough, is 14%. So it happens almost every year, even though those calendar year returns in dark blue are a reminder that 75% of the time performance finishes positive in the market. And then we often get questions from investors, should I move to cash? And even following a shock, cash is not a good long-term option. Here's the diversified portfolio, your 60-40 stock bond mix. It beats cash 73% of the time following a shock after 1 year, and 100% of the time after 3 years, with a significantly positive return, 24% in all of those cases. So not only does cash lose out, it loses out by a significant margin relative to prior events. So keep that in mind, that it does pay to stay invested right out the shock. Stick with your investment plan. This isn't the first challenge to financial markets. It won't be the last. So again, unfortunately, volatility is a price you pay for higher returns in the future. And another reminder to stay invested. The very best days often occur after the worst day. We saw an example of that just not long ago, with the S&P up 10% in a single day. That was the third strongest single day since World War II. It just shows you how quickly that followed after the April 2 tariff announcements. The week after, that Wednesday, with the removal of the reciprocal, a big sharp bounce back in the S&P 500. So again, given all the uncertainty, impossible to time, and it just goes to show you that you need to stay invested, not miss out on some of those best days. So some investing points, and then just to wrap up, volatility likely to linger. We're not going to get clarity on the economy or corporate profits for some time. First quarter earnings season is underway. We're listening for guidance, but the actual results for the second quarter aren't due out until July, and then third quarter results, where we might actually see the full impact, not due till October. So there's still a lot of drawn out uncertainty. The economy, in our view, likely to avoid recession, more like a very slow growth environment, and corporate profit margins likely to absorb a lot of this, but we'll examine the extent of the slowdown to determine a fair value for the S&P 500. Expect a choppy trading environment until then. On the positive news, the Trump administration is showing some sensitivity to market volatility based on some of their comments in recent weeks. Best way to address this is revisit your financial plan and stay diversified. That concentrated approach in the equity market, we think, is a thing of the past, and we do believe in diversification in helping your portfolio over time. Well, thank you very much for joining me. Again, apologies for the Zoom failure. We'll have this recording available to you. Thank you for listening, and we'll be back to speak to you again soon. Thank you.